let's get into it. So what we have up here is just a very simple SPY chart. Okay, this is the S&P 500. Not too complicated. Everybody has seen this before, right? Okay, take that little banner off. Now, what we're going to do is we're going to look at this and say, okay, we want to trade the SPY. That's all we want to do. So what are we going to do for an entry? Well, what we're going to do is we want to find out which way the trend's going. I have a full-time job. I am raising a family. I don't have time to sit here and watch every tick and watch us go up and down through the 5-day, every single day for the next week. So, and what you're dealing with is that chop. So what we're going to do is we're going to put in a 22-day simple moving average. 22-day simple moving average with a high, low, close. And we're going to put that in. Okay? So the only thing you have on your chart, you'll see I have no volume on. Okay? We're not looking at volume. We're not doing anything with volume. Okay? Has zero to do with this system. It's a very simple system, but it's based upon, you can, by the time you watch this video, you can actually take everything I give you, run it through a back test, and you'll see how you'll do. But you're trying to get in trades and hold in them for weeks. So you can see this line very clearly, this 22 open, high, low, close. What you're going to do, simple moving average, what you're going to do is your entry is going to be predicated. Your entry is going to be predicated on simply getting above the line. You do not need to wait for it to close above the line. You do not need to wait for it to, 1 15-minute bar or 1 minute above the line. The moment you are above the 22-day moving average, simple moving average, you execute a long entry. Let me be real clear about this. The moment that happens, that open, you're not looking at a 1-minute chart. You're not looking at a 5-minute chart. You're not reading RSI. You're not doing any of that. All right. One of the questions I get asked a lot is, how did you make the majority of your money trading? And I get this a lot in the room. It is from trend following systems. I will do the short-term trading in situations like we're dealing with now because the volatility is insane. Developing a longer-term swing trading model, and this is one part of it, I'm going to give you a longer one next week, will benefit people greatly. Now, that's your entry. Okay. So on the long side, I don't care if it's sloping. We'll get more into that later. I don't care if it's sloping. I don't care if it's not sloping. I don't care if it has earnings coming out. I don't care, right? It doesn't matter what stock it is. I don't care if earnings are the next day. It does not matter. Did it get above this moving average? Yes. Execute. That's it. Same for shorts. Okay. If I open up and I go above that moving average, and then I am below this moving average, that is where I execute my short position or short entry. Okay. So this is where you would go long. This is where you would go short. And you can see these examples everywhere. This is where you would go long. This is where you would go short. Okay. Even here, the day before, I think this was CPI, the day before CPI last time, you go short. That's it. It touches. Did it touch that? Yes. Do you want to do the trade on the short side? Yes. That's it. It's really that simple, right? You can put nuances in this, but it's a full system that you're going to get by the end of this. This would be your entry right here, just off the open. That's your entry. So above the 22 SMA, open, high, low, close, for longs, below the 22 SMA for short positions. Okay. Okay. So it is the 22 SMA, open, high, low, close. So it is this one. So because there is a difference there, Em. So right here, okay, you can do high, low, close, or you can do open, high, low, close. You want the entire picture in there. You want the open registering as a line. You want the high registering as a line, and you want the close registering as a line. There is a difference to this. Okay. Now, see that line? Hold on. I'll just show you what I mean by that. There is a difference to it. So if you go here, it's not a lot, but there is a difference. There is a nuance to it. So like put that line right there, right? And you can see where you're at. That should put roughly be where you are, 370.42. Okay. So you're at 370.42 right now. If I go in there and I change this to high-low 2, 370.47. So you get a different number, not a lot, but you get a different number. All right. So this is what I found that works the best. You can obviously play with any system and see how you can make it better for yourself. Now, one of the things I get asked is, and people are going to ask this, why a 22? Let me just give you an example here of a 20. Okay, there's my 20 and there is my 22. Okay, why am I using a 22? When I went back and calculated the amount of false positives, I got less false positive breakouts with a 22 than a 20. Okay, that's why I did it. This is going to be pretty trend following. If I take something else that's a little more wild, you're going to see that these might be a little different and they might trigger differently at different times. Okay, you're going to see that a little bit wilder on different times. I don't want a false positive reading, right? I want the least amount of false positive readings that I can get. So that is my back testing, and this is what I came back with. And I back tested this for years. Okay, so that is your entry point. So no, it's totally cool, Em. I appreciate it. So that is the white line. Now, that's the entry. Before I go any further, does anybody have any questions about the entry? Because that's about as easy as it's going to get. So if you have questions about the entry, please bring it up now. We'll address that at the end, Sri. I'll address that at the end. I would rather use a 20 than a 21. It makes the 20 is actually the mean. Usually, if you look at Bollinger Bands, the 20 is usually the mean of the move. So let's keep going. If there are no questions about entry, when do you exit? You exit when you touch above or below the 11 open, high, low, close. That's when you close your position. Okay. Now, if you're entering above it, you're obviously not going to close it when it hits here. You're going to use your stop. I'm going to show you how to calculate your stop. All right. What you're doing here is you're allowing the market to work. You're following the trend. Okay. So I want to be really clear about this. The goal is not to exit until I'm either above or below the 10-day moving average, dependent upon how you're putting the trade in. I will give you an example. I buy right here in October based upon my entry. I trade up all the way, comes back down, touches it right here. That's it. I am out. Trade is over. I'm not waiting for anything. I'm out. Okay. I enter my short position here. Okay. It comes all the way down here like this. Right. And I'm up 10%. I'm feeling good about myself, but I don't cover any of it until I'm here. So I've lost half my gain. Okay. People are going to ask why you do this. And I'm going to show you in a moment. You have to wait on this particular, you can do whatever you want, but on this system, this process, you must wait for it to touch this line. You have to wait for that to happen. Okay. Now, if you do that, you'll notice a difference over the long term with your percentage of winners being greater than your percentage of losers. Okay. This is not a system that I'm going to show you today that is going to be one of these, quote, 80% win rates. Okay. It's not going to work that way. But what it's going to do is it's going to keep you in winning trades longer on the short side and on the long side. Okay. That's what it's going to do. And it's quite effective at it. You are going to get false signals like everything else. You short up here, right? When you rally back into it, comes all the way down to here, right? You're not closing here though. And let's just walk through that one so we can get, so you get it. You're not closing here, right? You can do whatever you want, but you're closing here, right? So you're losing a portion of the move. You just have to accept that if you want to follow this exact. Breaks the 21, you're short. I'm sorry, I'm looking at, you got me saying 21 now. You breaks the 22, right? You break the 22, you're short, comes all the way back down. You are not covering here. You're covering here, okay? Why? Because you don't know when this is going to end. You have no idea when this is going to end. You assume you know when it's going to end, but you have no idea. Now, you can use this and these lines specifically for commodities. You can use it for, I don't care if you're trading currencies. I don't care if you're trading crude oil. It does not matter. That is your entry and that is your exit. I'll give you a great example of this, okay? So here you are with Tesla. Now, everyone's going to say, well, you could do this with any stock. Of course you can during these periods of time, but there's a method to it. Here you are, right? Let's say you buy it because it broke a 21, I don't know, around here or something, pops over it. Look at this move. Now, are you getting here on that move? No, right? You're getting here. So you're going to have to deal with some of these moves, right? Where you're going to lose 30, 40% or 10% of the move, right? 30 or 40 points, 10% of the move. But if you buy right on where you want to buy, okay, you're going to make this right here. You're going to make 70%. So instead of making 70% on your money, right, you made 55% on your money. But you don't know if this is going to 100, right? So the goal here is not to convince yourself that you can predict what the market's going to do. The goal here is to stay in a trend and follow the trend. There are nuances to this, but I'm going to give you a really good example, okay? Here we are, right? Broke the 10. We know that already. If you shorted Tesla here, okay, based upon this system, we haven't even gotten to the additions and scale. We haven't gotten to any of that yet. But if you just added here, right, an entry, this is what you're up so far. Okay, just off this one idea, you're up 30%. You're going about your day. You're not worried about anything. Okay. You start using this as your exit the minute you're up 1 times your stop. Some people will use 2 times their stop. I'm going to show you how to calculate your stop in a moment. Okay. Once you're up 1 times your stop or 2 times your stop, depending upon your risk parameters, as you learn this, I would recommend that you use 1, okay? Because these are longer term positions. You are trying to stay in these for weeks. For example, if you were doing this, you've been short Tesla for 3 weeks right now, okay? If you did this back here, right, when you broke out, let's say it breaks out, fails, you get stopped out, right? Over and over again, breaks out, fails, and you're going to get failed breakouts. Breaks out, fails, lose money. Breaks out, fails, break even, right? Breaks out, break even, right? Over and over again until you catch this. Okay. So you're going to have false positives doing this. I'll explain to you how to reduce those on longer time frames next week. But you'd still be short this. You don't care that it's a 222. You know for a fact, minus gap risk, right? You know for a fact that that's your worst case scenario, that you make 20% on invested capital. Okay. Now, you can do this with options. In other words, you could put a put on there and go out 2 months and leave the put on. You don't have to do this with stocks, right? If you want to be an options trader, but you have to respect the levels, and you have to put an option out there long enough that's not a weekly option. You have to go out at least a month on the option, because you don't know what you're going to get. You don't know if you're going to get this, okay, that goes on for months, or if you're going to get this. So you don't want to be adding a new position in the middle, a new option position in the middle. You'll get crushed, right? You have to do it when it triggers. So that is when you enter. That is when you exit. I can give you one more example, and then I'll take questions before we get into some of the more complex portions of this. Now, here you are on the 21, here and here, right? Let's just say, you got me saying 21 again. Here you are again on the 22, here and here, right? Simple moving averages. Put the trade on, okay? It's not a coincidence, right? It's not a coincidence, okay? I'm telling you, I've back tested this a lot, and you're going to see this a lot when you start looking for them. Now, what are you doing here? Look at if you did this here, right? The whole time you're riding this up off of Apple. When are you out? You're out here. So did you get 176? No, you got 170. Okay. Now look at it, right? Now you would have shorted here, stayed down. You would have gone to here, right? 153. And then you would have gone up to 157. And then you would have been stopped out at 159. So would you have gotten 20 points or 18 points? No. Would you have gotten 10 points? Yes. But you don't know if you're going to catch this, right? Or you're going to be able to put it back on up here, right? And then just ride it back down again and then go from there. Pardon me. And now if you're riding that back down, look what happens. Okay. And then eventually you break through it, right? And then it comes back up and you get stopped out, but you pulled out another $8 out of that because you don't know if you're going to get this, right? That's the whole point of this. You don't know when, oops, let me just see here what he had to say, because I'm hoping that he's going to, there's a simple moving average is used for ATR. This time it's hard coded, could not be edited. All right. I'm trying to get them to edit their ATR for me so I can keep you all on one system. I don't think they're going to edit their ATR for me. So I'm going to get to this, and this is going to be proprietary, but we're going to go through this in detail on how to do this and add to positions. Now, the goal for this, let me go through these questions. It's easy enough so far. And an option is good. This is a good way to trade options out 3 months, 2 to 3 months, 1 to 3 months, I think. Okay. Once you mention you're up 1x risk, what's the rest of that? We're going to get into it all now. Okay. And I know that this is complex, what we're about to get into, but I'm just going to tell you to kind of stay with me. Now, one of the things that people will say all the time, I wish I had a larger position on. Man, I really wish I had a larger position on. Well, what if there was a way to do that? Okay. I'm going to show you how to do that. So what we're going to do is we're going to flip to another system. Right now, the system I found that I can do what I want on is on TradingView, and it's free. So you can use TradingView system for free. I'm going to stop the screen. So I'm going to edit this out and make this like very formal. Here we go. Perfect. So what we're going to focus on now. What is my stop and how do I calculate my stop? Well, one of the core things that people have been saying is, shouldn't I widen my stop based upon volatility? The answer is yes and no. If you're day trading, no, it should be actually tighter. If you're looking at 1 to 2 days, no, it should be tighter because you're not making enough money. If you're looking out weeks, absolutely you should have a wider stop. If you're looking out weeks, okay? So what we're going to do is we're going to show you a very simple calculation to figure out what your stop is going to be to start. So you're going to go on to settings. This is ATR, right? I'll start at the beginning. Average true range, right from the indicator. Okay. Now, simply click on the settings, change the length of this to 20. Okay. RMA, smoothing. Now, EMA, exponential moving average. Okay. Why am I using an EMA? Because they front load EMAs. So I want to know the most volatile time now. Okay. So you're going to use a 20 length EMA. All right. TrendSpider does not have this. There is a difference. I'm going to show you the difference in a moment. Okay. So you can see very clearly we are at 14.15 here, right? If I put this on, and I'll get back to that in a moment. So if I'm going to trade Tesla, I'm going to have to use this line, right? And that's going to be my stop if I'm trading Tesla. So at this particular time, if I'm trading Tesla, let's put in that moving average so that we can do that. Just go simple moving average. See which ones I can use. I can just use these three, and then I'll just change them. We'll change you to the 22, and we're going to change you to the 11, and we're going to change you to a 400, just because you'll be out of the way. All right, perfect. And then we're just going to click on you. I don't know if that's going to remove them all. I think it might. Just stay with me 1 second. I figure this out. There we go. All right, good. We're just going to get rid of that and go from there. Perfect. Now, the yellow on this chart, maybe I can change these colors to match them exactly as they were on the other so that I'm not confusing you. What did we use on the other one? Yellow for 10. That's the last thing I want to do is just change the colors on you and confuse everybody. There we go. Okay. So, same colors. 22, 11. Let me just change that. The inputs, source, open, high, low, close. Open, high, low, close. Yep. And you saw the little jump there. Now, here you are, right, at 14, but it doesn't matter where you were then. This is where you were here. So you have to go on the assumption that when you're there and this is your break right here, this is your stop loss to start on that trade right here. Okay. $12. So when you're putting this on, your stop to start is a $12 stop. Okay. It is not a $2 stop. It is not the top of this bar. Okay. It's got nothing to do with that. It is a $12 stop. You must go in the opposite direction, the amount of that ATR. That is going to change the size of your position drastically because people are not used to that. So you are putting on a very wide stop in comparison to what you're used to putting on. Okay. And that's something that people are going to, yep. No, correct me if you see something. So just correct me if you see something wrong. So what we have now, we have ATR at 20 EMA. That's where your initial stop starts. So when you put this trade on, okay, you're putting a trade on here. Your stop is 12 points from there. So from 290, right, you'd go to 301. Okay, well, that's going to take you to 10, right? And then you're going to go 302, 303, 10, right? And that's going to get you 12 points. I think that's what it was, 12, right? 303, 10. There you go. Come on. All right. That's your stop. Okay, when you look at this, that's your stop. That's how you map out the trade. Okay, that's your entire trade. Entry, exit. Okay. Now, when does this 10-day moving average, or I'm sorry, 11, you guys are killing me with the questions about the numbers, throwing me off. When does this 11-day moving average become the stop? Because that's what it becomes, right? It becomes your exit, your stop. It does not happen until you break this down $12 or 1 ATR of the initial move. Okay. So now I'm 291, 268. So now I'm at least down my 1N, right? Even here, you're down that 1N. I can even move it here. You're down that, right? You're down that 1R, right? Now, if you're down that 1R and you come back up, okay, it doesn't matter. You're still in the trade. Side note, you can, if you missed this and it dropped down, you can always re-enter when it tests there again and do the same exact trade. Okay. If you miss it once, it doesn't mean that you missed it. You can always try again. So some people might want to wait and see if they take out the lower low. There's nuances, but you get what I'm putting down. So what I'm getting at here is now this becomes your exit and you would not have been out of this trade yet. Any questions on how to exit? Yep. Let's go through the ATR stop again. ATR is average true range. This is the true range of a stock. This is the true range of a stock. Okay. And what does that mean? That means that this is what you're expected to see in a move during a period of time. We're using 20 and we're using an EMA to front load it. What is that giving us? That's giving me a level right here that's associated with this. That's telling me that we are at 12. Right here, it's actually a little less. Yeah, it's 12. So now here you are at $12. So your stop is calculated based upon the average true range. Okay. So in other words, and that's why I said, this is going to get a little more complicated. But we'll go through it a couple of times, watch it, and then we'll take questions next week and we're going to expand on it. So is your stop. Okay. And it's predicated right at the time of entry. That's your stop. That's where you start. Once you're up 1 times your risk, you don't trim, you don't do anything. Okay. Once you're up 1 times your risk, your stop becomes the 10. Once you're up 1 times the risk. So if I'm up 1 times the risk and I bounce all the way back to here, then that's what happens. And then I get stopped out there. I'm not going to break even. I'm not doing anything like that. I'm not looking at the news. I'm simply trading off of this particular system. That's it. You're free to act however you want. The process does not really allow for that. It's basically just a way to put trades on and leave them on. But this is where you enter, and right around here, it's like $12, really. I mean, it's actually the next day, right? I mean, like here you are. I think it's like really right there to be completely exact. Once that triggers, that's it. And it's once it triggers, it's not the close. Once it triggers, that's it. This 11 becomes your stop. Okay. You're going to have to calculate that out. Can you use this strategy for day trading? No, you can't. You can use the entry, but this is not for somebody that's trying to day trade. Okay? This is not going to be optimal for day trading. I can give you other systems for day trading that are based upon the volatility and volatility stops. I can definitely do that. But this example and what we're going over today has zero to do with day trading. This is geared towards one of the things that I'm noticing in the room. So one gentleman the other day was like, I don't have the time. I can't be in the room all the time. All right, well, I'm going to have to start putting on longer time frame trades for people that can't be in the room all the time, despite the volatility. Well, there's only one way to do that, to use trend following systems. There's no other way to do it. You have to follow the trend. Well, people say, well, there's no trend. I would argue that we've got 4 very distinct trends right in front of us on Tesla. 1, 2, 3, 4. When it's trendless is when you're going to keep getting stopped out, but it's going to get you in there for the trend. And wherever you're getting stopped out of is going to be completely irrelevant to what you're going to make on the trend, right? It's completely irrelevant. So now let's keep going to this. Okay. I feel like this may be complicated. How do you size appropriately with options when using ATR as a stop? You better calculate correctly. You need to calculate correctly. So you need to look at this and go, I need to stay. If I'm going to do an option here, I need to stay. If you're going to use this system, you can use whatever you want, but if you're going to use this system, you're going to need to spell out that I'm not closing those puts until I'm up here. Now, that might mean that you're doing a completely different option than you're doing. You might start realizing that I don't want deltas of 55. I want deltas of 45, so I'm not losing as much. I only want to go out a month on these, not 2 months, because I don't want the time decay if it goes against me, right? So you're going to have to figure that out, and we can build models around that. I mean, that's simple for me to teach people how to do, but you're going to have to look at your theta. You're going to have to look at your time value. Do you want to front load your time value or not, right? Like that they're all different questions, but you're going to have to calculate that. The easiest way to calculate that is back of the envelope. Just look at the delta and you'll get a rough estimate within 10% of what you're going to lose, right? Unless the volatility just completely contracts, unless the time just goes away and evaporates, unless there's a binary event, you should be able to just look at delta and be within 10% of where you're going to be just by calculating delta. That's a rule of thumb. It's like 10%. So meaning that if you take into theta and gamma and everything else and beta, delta is going to get you 90% of what that move's going to be versus the rest. So hopefully it's not too complicated. I can do that, Sri. I can definitely do that. So this is your stop. Yes. Would you ever stagger stops or use a stop limit? Yes, there's a completely different staggered stop system that I'm going to give you. And we really haven't gotten into the complex part of this yet. That now we're about to. So my trade is here, okay? And my trade is working, okay? So I'm going to get rid of this line. My trade's here and my trade's working. It's working right here. When do you add to your trades? Okay. Can you add to your trades? So I want you to think about this for a moment. Okay. How many times have you said, man, I really wish I had more of that one, right? You want more of your winners, right? Okay. So the calculation of this ATR, we're going to say is 12 because that's what we've been going with, right? When you get to half of the average true range on a new position, you can add to it. Okay. So what you're going to do is you're going to add to that. So what I'm going to do, just to make this simple, is I'm going to flip back to the other system because I think that'll be a little easier to see, unless you'd rather me just stay. Maybe I'll just stay here. So I'm just going to stay here because I think it'll be better. So what you're going to do is you're going to realize that 12. So where would you add? Right? You're going to add. You don't have to add, by the way, but once you're down, that's 6 points from here. Okay. You add. So if you go here and you go 91, right? And you go 85 is going to be 6 points, right? That's where you would add. Okay. So you would add here to the position. Okay. Now let me be really clear about this. Your stop hasn't moved. Okay. You entered here, you added here. Your stop has not moved. All right. Let me be really clear about that. Now, you can add up to 5 times. Usually I wind up not doing more than 4. So now I have added to that position. Once you're at this position, I wait for the ATR again, right? 6 points, right? So here we are again. 6 points off this line is what? 279. I add again if I want. Where's my stop? Right here. Okay, my stop has not moved. Okay, so am I increasing the risk as this goes on? Yes, you are increasing the risk. Now, there are different ways to stagger this and ways to stagger your stop. The most profitable way is not to stagger the stop, but we're going to get into it. It's actually called being whipsawed, but let me just go through this. So here you are, right? 1, 2, 3, 6 down, right? So now we have to go 6 again, 272. There. Okay, so that's 4 positions on. Now, by the 4th position, right, you are now down what? Okay, you're now down 20 points, right? Roughly. You're actually down a little bit more than that, right? You're down like roughly around 24 points is really where you should be. So if you are down to that level, okay, you can do a couple things. One, you can move the stop if you want to your break even, which is not what I would recommend. I would recommend leaving the stop on where you're at. Okay. If you don't want to do that, don't do the ads. You don't have to add. You don't have to increase your risk. The goal is to continue to follow the trend following system. It's really important for you to understand something too. So from this section, right, this is where we entered, right? From here over, right? So let me just show you this. So that's where you entered, right? Right over here. Let's just open this up. So if you entered here, your ATR does not go up. In other words, when I entered, the ATR was 12. Take half of 12, it's 6. You don't change the position when the ATR moves. It goes off your initial buy. Okay? It goes off your initial buy. So now you've added to it, right? 4 times. If you want to add again, that's up to you. If you want to move the stop up to break even at that point, right? Or back to your original position, that's up to you. I'm going to teach a staggered stop strategy on all this next week when I show you how to do this for even longer term stocks. But this gets you in the trade. Now, say you're doing options and you're buying options every single time that this happens. Same thing. You have to calculate your risk. If you're not willing to take the risk, you don't do the trade. Okay. This is a trend following system. Your losses are going to be greater. Your gains are going to be greater. Okay. Now, instead of having, let's say that your normal position size, what would this have done? Instead of you having one position size, let's say that your average position size is 100 shares. What you would have here is 400 shares, right? So now you have 4 times your normal position size because you've added, and now you're sitting here, and this is your stop. Okay. So it's not so much about that I've got to make sure that I get out here as much as I need to make sure that I'm adding at the correct levels so that I can get the most amount of money here, right? I'd rather have this as a stop and have 4 times the position size than be someone here saying, I'm going to close it now. Okay. So that's how you enter the trade. That's how you exit the trade. That's how you add to your positions. All right. So I covered a lot. That is the gist of this. If you do this, you will do well, but you have to stick with the plan and you have to look at what you're willing to risk. So I'm going to tell you right now on this one, to me, on a longer time frame, like First Solar, I'm going to show you this. This is a short, point blank. There's no question about it now. And I'll get into it later in Sunday's newsletter. You know, I'm thinking about it and teaching off of that one for next week. So this is Apple. You would do the same exact thing here. Are you going to catch every single move? No. You're going to get stopped out of some, right? But you know when you could put the trade back on and start again, right? And you don't have to add. You can just keep the initial position on. Whether you're going to have, 1 times the size of your normal positions or 4, that's up to you, right? But whatever that unit of risk is, you add the same amount each time. You don't increase it. So that's the gist of the system. And let's go from there. The 6, how did you get to the 6? Let's make sure you get this so you understand it. So the 6 is calculated by 1 times, the risk. So like, let's say right here, I entered an Apple short. And again, it's the moment it touches the 22 open, high, low, close. Okay. So the moment. You don't have to add into here if you don't want to. You don't have to be aggressive and do that. You don't, right? That might throw some people off and they might not want to, right? But what I'm going to tell you is it's not up to you when you add, right? Please understand that. So here you are. Let me give you an example what I mean by that. So here you are, Isaiah, right? So here we are, right at that 3 level, right? 350, we're going to call it, make the math simple, okay? So the minute that I'm down $1.75 from that level, that's when your next position goes on, right? So if I'm in here, then when I'm down $1.75, that's when my next position goes on. So here you are at 166, and we'll call it 165 3/4 right there. Okay, that's actually lower. I'm sorry, apologize. 150. Need that 50, right? So that's when your next position is. Not when you feel like it, right? It's half times the risk. You're doing this based upon the volatility of the market. Okay. So that's when that's when your position is. Okay. Then you would come down again, right? And this is roughly where you're going to be. Well, that's 164, 165. So that's not really going to get you. That's going to get you closer to that 2, but it's there. So then you would add again if you wanted to. Okay, then you would be adding again if you wanted to, right? So it'd be 162 right here. So here you would have 4 positions on, right? Now, in this example, just so we're very clear about this, if you did that trade, right, you're not closing any of it into here, none of it, right? You're at 152 and you're not closing it. You're closing it here at 159. So you're going to have to wrap your head around the fact that you're not going to get the lows on this. The goal is to stay in the trade, right? It's not to get out. You don't know that this is going to happen. You don't. Okay. Just like when it broke above the 21 this day, pardon me. Just as we know when it broke above the 21 this day, we don't know that this is going to get that run. We have no idea. Some people might even get stopped out right there. We don't know, right? You don't know if that's going to happen. Actually, you wouldn't have gotten stopped out because the number is 141.93 and it's 142.12. So you wouldn't have gotten stopped out. And look what happens. Okay. I mean, look at that move that you caught off of doing this. And the reason I'm pointing out this move, just so you get it, right, off of something like this, right? That's your move that you caught. Are you going to care if you catch one of these moves? Are you going to care that you got stopped out here instead? You got out at 169. I got out at 169 or 167 instead of 176. Maybe, or maybe you're going to be thrilled to death that you just made 25 points and didn't have to look at the chart all day, right? So the system's not for everybody. It's for people that don't want to be glued all day long, don't have the time to be glued all day long. Okay. You don't have to do the ads, but that's how you add. It's 1 times average true range, which is calculated off a 20 EMA. And you're going to have to use TradingView or some other system, maybe Toss or some of these other systems will allow you to do this. Maybe they'll allow you to do it, but TradingView will not alter their code or give me access to their code. Okay. First ad, half. Second ad, half. Third ad, half. Yep. Every half. Yes. You don't have to add. You don't. Some people want to add. Some people don't want to add. They want to put the trade on, leave the trade on, and go from there. If it's a new system to you, what I might recommend is that you don't add to it. You just let the trade play out just the way it's going to. In the example of the put, would you choose a strike at your entry at the price? Okay, in regards to puts and doing this with puts, you need to be really very careful. So how would I do it with puts? I would find something that I'd want to be in, right? And then I would go from there. So how would I do it? I would be looking at like the VIX to start with and go, where's the VIX? Okay, the VIX is up. So implied volatility is through the roof, right? So we know that the VIX is up. If we know the VIX is up and we know that implied volatility is through the roof, okay, what does that mean? Right? What does that really mean if we know that implied volatility is through the roof? It means that we know those options are going to be more expensive. So we know that we're not going to make the same amount of money. Okay. There are strategies for this. I can do a whole option class on this strategy with options. I could spend an hour on that alone. My advice would be to look at something that has about a 40 or 45 delta that goes out at least 21 days. That would be my advice, because there's nothing that's going to be more annoying than you being in the right idea. Okay. Than you being in the right idea. Remember when we did this, for those that were in this, or were with the community at that time when we started shorting this. So imagine shorting this here, right? And you have a 3-week option on. Okay. Imagine shorting here and you have a 3-week option on and your option's out. Now you're out. Now what do you do? Right? You're happy. You made money, right? Look at you. You killed it, right? You shorted at 100, 123, you're at 70, you made 50 points. You killed it, right? You're not staying with the trend, are you? Okay. Here's your trend. So if you just did like a 3-week option, right? You can do it and you can do it all over. You can go find trades. But if you did it this way, right? What does that do for you? Now you're out. So you would have missed, if we just kind of go from here where that was 75 was, right? It was right here, right? 75, that would have been that 3 weeks right here. So now what does that do for you? Well, now you've missed from April to May. You just missed a whole month of gains. Okay. And you missed, instead of having this enormous trade on, right, that just kept going forever, you have half the gain, maybe half the gain, maybe, right? It actually might only be like a third of the gain of the entire move, right? Again, this is a trend following system. If you bought it here, you're getting out here, right? If you bought it here, right, when it rallies up, you're getting out here over and over again, right? So with options, you got to go out further because you don't want to be this. Don't be this guy. So you're going to have to go out further. It's not about buying that dollar option and trying to crush it. I know you're not saying that, Emily, but you can do this with anything, right? Pick a stock, right? And you're going to find periods where this is going to work, and you're going to find periods where it does not work. Nothing's 100%. All I'm trying to get you to do is understand that this got you in, and then you rallied up, right? And then this got you out. And I'm not saying it's right. I'm just saying what happened. Okay. That's all I'm saying. This is what happened. So keep that in mind. I hope that helps. How does this work for Accounting Hub with PDT limitations? I have no idea. Not a clue, Utu. If you have limitations, first off, let's say you have pattern day trading limitations. Here's my advice. Stop day trading so much and look at following an actual trend, right? Like, let me give you an example of what I mean by this. Here, I'm going to stay on this system. Just take what I'm saying for what it's worth. Okay. If you were to follow a system like this and you went long the market here, right? If you went long here, okay, right here, and then it traded all the way up and it came all the way back, you still made money, right? You still made money. Your next signal's here. You shorted here, right? Comes all the way down, and then it comes back. Okay. You still made, right? 7%. You still caught 7% of the move. Trades up, gets near it, right? If you did the trade, great. If not, going into some events, people might not do that trade, right? And then you're out here. You still made money. So the question is that you have to ask yourself, Utu, do you want to be doing all these trades all the time? Or do you want something that's maybe a little bit longer term that's going to keep you in a move, right, for a period of time? Okay. And I would argue that if you could be in from something from November 8th, from this date, from October, and you could be in something for, 3 weeks, 4 weeks. Okay. Maybe you should be doing with a portion of that because that's going to help you grow. When I started this video, I started with two things. Number one, people ask me all the time, how did you make the majority of money trading? Trend following systems and adding to winners. That's how I did it. Okay. It's not that I don't make money doing the day trading. I do. But what I'm getting at is the majority of money that you can make and put to work as the accounts get bigger and bigger is limited in day trading. Okay. You can't do it when your accounts start getting really big. And some people are going to start doing this and start having bigger accounts, right? We know the law of probability. It's going to happen with some people. As your accounts get bigger, you can't be out there day trading, these little names. It's not going to work that way. You have to think about your end game. Where are you at in 5 years after doing this, right? How big is your account? Like, you should have these kind of goals. And where I'm going with this, Utu, is if you're doing one of this, or you're doing some of this, maybe that shouldn't be an issue. Maybe it should be more focused on, do I want to do some of these and try to catch a long-term move? That you could think about it that way. And again, you can do it with anything, right? Literally anything. I don't know. I'll give you another one, TLT. Right. You can do it with anything over and again. Does not matter, right? Let me do crude oil just to give you an example. So here's crude oil. Okay. This would have been your buy on crude oil, right? Crude oil would have gone from here all the way up. You would have thought you're a genius, and now you're stopped out. Okay. So you made some money, but you didn't make this. And that's what you have to wrap your head around. There is no trim. There is one exit, and that's the exit, and it's mechanical. That's where people run into the hardest problem. Yes, that analysis tool in TOS is actually fairly good. You're right, Tug. Yeah, I can show you how to roll. There's a couple ways to do that. It's definitely longer term. You're trying to stay in for weeks. Yes, right. You can, but you can't be using this system that I'm teaching you on a lower time frame. But you can use ATR for that. Yes, there's a way to do that. Hey, Peter. So this is how I trade. Okay. And I can only speak from my experience. If I go to a job site and I'm a contractor, I find this is a really good example to explain to people. I don't go into the job, right? I don't go into the job with the same tools dependent upon the contracts. So let me give you, I'm going to leave this chart up here, but let me do it this way for a moment and close all this so you can understand what I'm doing. And I'm going to kind of go through this to answer your question, Peter. So we're going to get rid of these and we're going to I'm just going to shrink this down. Okay. In case we come back to it with another question. Here's the S&P over, right? They're going to give me to 93. Okay. So during these market cycles, right? Do you think it makes sense to use one kind of system, right? Versus using another kind of system, right? So what worked here is what worked here going to work here, right? Probably not. Okay. So if we go there, so is what worked here, right? Going to what worked here? No. Okay. What about here? Okay. So my point that I'm getting at is every time you go to a job site, you don't know what you're getting if you're a general contractor, right? So to tell me that you need a drywall tool when you're going to do electrical work makes no sense to me. Okay. That's where my head is. This is one of my issues that falls on deaf ears when people start talking about all I do is can slim. Well, then you just need a bull market because none of that's going to work right now. Okay. It's not. We can try it. And I'm not saying to not try it. Heck, we put some trades on that fit perfectly into what can slim is. Like, look at this twink trade we just did, right? How'd that go? You know, right now we're down about 50 cents in it. Look at this HLIT. Okay. We're down 50 cents in it. So yeah. Do you try to use the same principles? Yes. Do the same principles always work in every environment? No. Trend following principles can work in the majority of environments. When they won't work is when you start going sideways. If you go sideways and you're using a trend following system, you're going to have a hard time. Okay. We are not in a sideways market, but if you are using a trend following system like I just gave you, and you are in a period of something like this, right? Where you literally have gone nowhere from the 14 to for these 2 years, and you're using what I'm talking about. Okay. You're going to go batty, right? You use it. You're using it when you're following a trend, right? Not when you're locked in. You're just going to you're going to keep getting stopped out over and over again. That's what's going to happen, right? So maybe you're not using this market. What you're doing is maybe you're going to find a market that's benefiting off of what's going on, right? Maybe you're going to go find another market, right? So maybe you're not going to trade the dollar with the system for the past 5 years, and now you're going to start trading the system with the dollar, right? So that's up to you. But I do not use the same tool for every job. I hope that helps. If I can always get through it more, Peter, not. Oh, it's very easy to set up scans, but you're not going to be able to put a lot of trades on, right? Well, it depends how much money you have, but your goal here is, you know, if you have 5 of these on and you've added to it 4 times, I mean, I don't know how much risk you want to take, but that's a lot of risk for your portfolio, right? I mean, you could have a 20% drawdown if you do the math, depending upon the ATR. So you're going to have to look at this and calculate out your ATR and your risk. But yeah, you could come up with that. Look, this system, okay, this is the kind of system that's going to get you in something like this, okay, and stay in it until it's back down to here, if that happens, right? That's how this is going to work, okay? And that's how you have to look at it. Now, there's nuances to it. There's ways to stagger the stops, which I'm going to get into. There's a long form to this that can keep you in these trades for months. I'm going to get into that as well, because there's a way to stay in these trades literally for months. Like, you just wouldn't be stopped out, but you have to be, and the signals are a lot less. And we'll get into that as well. You can run all types of scans on this. Yeah, exactly. You want it to be like a cruise ship. You start like you're a speedboat, and it ends with a 400-foot yacht. Exactly. Sure. When it hits the 11 SMA. All right. So watch this a couple times. And then if you have questions, reach out. I'm going to edit this and look at it. But let me know. And I know this was a lot to grasp, and I'm going to add to this next session. I'm going to give you a longer time frame scenario that I ran, and I'm going to give you a way to stagger stops on specific positions, meaning the additions, how to stagger stops. So that's it. Any questions, please reach out. All right. This is for daily only. The whole purpose of what I'm giving you right now is for people that I've been talking to a lot of people that are in our community that have full-time jobs. Okay. And they're missing calls. And so I'm working on an SMS system I might beta test an SMS system that goes to people's phones. I need longer trading strategies that people can start understanding and implementing on their own ideas, as well as a system that I should probably be putting some of these in the newsletter so that people can monitor these. Okay. Monitor these over weeks. So it doesn't really fit for day trading. If you're looking at day trading and you're not using the other system that we came up with, John, like if you're trying to day trade or stay in for a couple days to a week and that's your time frame and you're not using that 358 system, I mean, it's everything right now. Every time we're above those lines, it's working. Every time we're below those lines, I mean, I shouldn't say every time, but it's working like clockwork. It even worked on Friday. I just didn't execute on it because I wanted to stay out of the way. Just in case you forget, which I will forget, the significance of the number is basically them back testing and changing it. It's like everything else. They started with 21 EMAs. I don't use EMAs on my moving averages because I want real data. When you understand how this is calculating, you don't want EMAs because they front load. Why do I want front loaded data? I want SMAs. Yeah, I can definitely do the day trading on the ATR. Reiterate dailies. Yep, it's dailies only. If you're interested in shorter time frames, 3, 5, 8, VWAP, RSI, I mean, you should be doing fairly well with those right now. Do you wait for the cross to confirm the move? No. Now it touches it. That's it. It's on. It's on like Donkey Kong. Well, that's what I'm trying to get at. I'm starting to realize that some of these trades, it might be helpful if I walk through some of these and then I show people how to add to them and, put some of these examples in the newsletter. But I really, look, is this an alert service? Yes. But my goal has always been education. My goal was always to elevate people and to give them the tools to be successful, right? That's the goal of what I'm doing. And so that's why, I mean, if you can start implementing this over time, it might take you like a year or two to really get it, right? I don't expect to get this from this one class. You have to watch this and practice it and you'll get it. But it takes a solid year of doing this to get it. And when you finally do get it, you're probably going to really like trend following systems because it really alleviates a lot of the guess. I would call what I just gave you swing. This is really what I'm giving you is something proprietary that I put together over years after reading several books and execution and back testing. You're not going to see anybody else telling you to look at an 11-day moving average as a stop. You're not going to see anybody else that's going to teach you how to use a 22-day moving average. No one's going to show you how to calculate ATR off of 20 EMA. Like a lot of this is proprietary, Emily, that took me a long time to figure out to extend the EMA past the 14. Like there's a lot to this. So I never really came up and coined it anything. So I just thought it would help people understand why you might start seeing I'm going to start doing some of this in the room and in the newsletter for longer term ideas. Because I don't think everybody's adapting to what's really going on. I think it's moving too fast for everyone is what I'm getting at. Like it's not moving too fast for me because I'm on it, right? I'm on it all the time. But these moves, we're moving so fast. Having a longer term outlook is probably not the worst idea, right? So this is swing. I'm going to show you how to do something for months next week, how to literally stay in trades for months. So yeah, a little bit of a math geek there. It's funny. Kind of am. All right. If you need anything, reach out. I'm around. I know it's a lot.